If you're smart and want to become rich, you will absolutely ignore the daily finance YouTube videos. I am paraphrasing the line from the book The Simple Path to Wealth. The author is a big fan of financial independence. He achieved his financial independence by buying a low-cost total US stock market index fund. So instead of YouTubers, he refers to CNBC in his book. Similar to some of the finance YouTube videos in my opinion. Finance-related videos mostly talk about the daily volatility of the markets and specific stocks and market crash predictions. You need to understand that CNBC and news-related YouTubers are looking for drama. They will make more money and generate more views when there's drama in their story. Would you rather click on a video headline that reads "Market went up by 2% again" or "Joe the expert says the market crash is coming"? What you need to know before it's too late. Maybe you already know this, but if you don't, I want to address this. CNBC or other news-related websites, including many YouTubers, make most of their money with ads. The more people watch their videos or visit their website, the more money they will make because more people will watch their ads. So knowing this, you know that it's in their best interest to publish a new video as often as possible, since more videos equal more views and more money. But is it in your best interest too, to watch every finance-related video published by your favorite YouTuber? No, it isn't. Ever heard the saying, you are the average of the 5 people you spend the most time with? Well, if you spend lots of your daily time on YouTube, you will be influenced by the content of the videos you watch, whether you like it or not. Even if you think you only watch them for entertainment and don't take action on it. They still have some sort of influence on you, hence the name influencers. So if you see one of your favorite YouTubers putting a pile of cash into a specific stock over and over again, you might do it too. But should you really follow in their footprints? Their reasons for buying that stock might be different than yours. You want to bulletproof your financial future, or maybe you don't even think about your future yet and just find it fun to buy these cryptos and stocks and talk to your friends about it. Popular finance YouTubers already have their financial future pretty much bulletproof and are buying these stocks because it's fun, or they do it for the sake of creating fun content for you to watch. Just another new video to post. It's not really fun to create a new video every day or week to say they bought 10,000 shares of a low-cost index fund. What more is there to add to that strategy day in and day out? So, coming back to the book I recently read, The Simple Path to Wealth, he explains why most people lose money investing in the stock market. He writes several reasons why most people lose money in the stock market. And I'll name 3 of them I find most important to address in this video. So the first one is because they think they can beat the market. And that's what's happening when you take action on some of those CNBC articles or finance-related YouTube videos, saying the stock market will crash. Heck, I made one of those videos a while ago where I discussed several experts and their projections on the market. Jeremy, one of the experts I discussed in the video, wrote an article in January this year where he guesses that the longest this market may survive is the late spring or early summer. He thought the market would crash in the spring or early summer. So if you listened to his advice and took your money out of the market, you would have lost some decent gains in the past few months. So the other reason why the author of the book The Simple Path to Wealth believes most people lose money in the stock market is that some think they can pick individual stocks. They might have some luck by picking a winning stock 1 or 2 years in a row, but beating the index year over year for a 20, 30 or 40 year time period is near impossible. Only a handful of investors have a track record of beating the market for a more extended period of time. One of them is Warren Buffett. So the third reason is not a reason that's in this book, but it's one of the reasons I came to think about when talking to one of my friends the other day. So the reason is having patience. One of my friends has 0 patience. He wants to double his money within a day, week or a month. He can't be asked to invest a couple of $100s every month while waiting for that investment to double in 6 to 9 years. That's why he's laser focused on cryptocurrencies and trading on margin. He has lost his money multiple times, and every time he tries again, shorting Bitcoin or another crypto on margin. Sometimes he wins, but in the end he's still reporting red figures instead of green ones. So I remember the conversation with him years ago when he talked to me about Bitcoin and the things he was doing. I bought a small piece of Bitcoin last year and I'm just holding on to it. And I'm still in the green, even the fact that Bitcoin took a significant loss the other day. My friend still in the red and still doesn't hold any Bitcoin, even when he talked to me about Bitcoin years ago. If he just bought some of it and hold on to it instead of margin trading every time, he might have had a couple of Bitcoin by now, instead of nada. So I believe having patience is the key to long-term success in investing. So the author mentioned some cool examples in his book about investing long-term into an index. He mentioned that from January 1975 until January 2015, the S&P 500 index produced an annualized growth rate of 11.9%. So if you invested $200 per month in this time frame, your investment would have grown to $1.5 million by 2015. Just a one-time investment of $10,000 in 1975 without any additional investments would have become close to $900,000 by 2015. And you need to know there were many waves of panic, collapses and recessions in this 40-year time frame. So what does this book, The Simple Path to Wealth, advises you to do? In other words, what portfolio should you run? In short, he explains that if you're young and earning income from your day job, he suggests a 100% stock portfolio. The fund he prefers to buy is the VTS-AX, the Vanguard Total Stock Market Index Fund. This fund holds 3,791 stocks, and some of the top stocks in this fund are Apple, Microsoft, Amazon and Facebook. So the beauty of this fund, as he explains it, is that it only has an annual expense rate of 0.04%. The difference between investing with an annual expense rate of 0.04% and 1% is tremendous. If you were to invest $200 per month for the next 40 years with an annual return rate of 8%, you would pay a total cost of fees of $7,276 if there is a 0.04% expense ratio. If that expense ratio were to be 1% instead of 0.04%, you would pay a total of $158,811. Imagine what you can do with that extra money. That's why it's crucial to focus on your yearly expense ratio. So I live in the Netherlands and the broker I use for my investments doesn't offer the VTS-AX. Therefore, I choose to buy the Vanguard S&P 500 index, which is pretty similar to the VTS-AX. I also buy the Vanguard All World Index and a bit of the Vanguard Emerging Markets Index. So I'm not only focusing on the US market. Inside the book, he also talks about investment strategies focused on people living in the US, such as setting up a 401k, IRA and Roth IRA. Since every country is different and this isn't relevant to me in the Netherlands, I haven't looked into that. But it's definitely important for you if you live in the US. So one other thing that is relevant to me is the comparison he makes between the dollar cost averaging strategy and the lump sum investment. In other words, let's say you have a big pile of cash sitting idle in your bank account and you're planning to invest that money into the stock market. Should you dollar cost average your way in, or should you put it in all at once? So I chose the first option, the dollar cost average method. Since October last year, I've increased my monthly investments to 10,000 euros per month because I had too much cash at hand. At that time, I had around 80% of my total net worth in cash, which is of course way too much knowing what I know now about investing. In my view, I thought the most risk-averse option was to dollar cost average my way into the market, instead of just putting it in all at once. But after reading the chapter about these two strategies, I made the incorrect decision. He explains in the book that by dollar cost averaging, you are basically betting that the market will drop. Apparently, the odds of this happening are only 23% on average. But the market is about 77% more likely to rise. In which case, I have spared myself some gains. And this is exactly what happened in hindsight. Each month I invested again, I paid more for every share I bought. You can see it here. In October 2020, I paid 53 euros per share, and in April 2021, I paid 65 euros per share. Of course, this is all in hindsight, and it could have gone the other way, but looking at the percentages given in the book, the odds were not in my favor of betting the market would drop. So the thing is, I find it a bit scary to drop 50, 60 or 80 grand into the market all at once. If the market were to drop the day after, I would emotionally not feel good. So spending more money for every share I did now the last few months doesn't hurt as much since I see myself in the green. I understand it's only a feeling, and I also know you should avoid mixing emotions with investing. But we're still humans, right? We're not emotionless robots. So the last thing I want to mention is your monthly and yearly saving rate, which is an essential piece of reaching financial independence. In the book, he explains the advice he gave his daughter. So one part of the advice is how much one should save and invest. And he believes you should aim for 50% of your yearly income. The average saving rate in the US was 7.6% in 2019, which is far below the 50% he advises in the book. So I understand that saving 50% of your income is a lot and it might be difficult or seem impossible for your situation. So the thing that's important to mention is that the sooner you start investing your money, the more time your money has to double. If your investments return 8% per year on average, it takes roughly 9 years for your money to double. Investing lots of your money in your younger years is crucial to benefit from doubling your money. So in the end, I'm not saying you should quit watching YouTube videos altogether. I do believe you should diversify your knowledge intake. In other words, instead of solely relying on YouTube for your financial education, you should read books about them. Books are cheap and often have the best information there is about a particular topic. Furthermore, by reading books, you get a much better understanding of the topic. And after you can form your own educated opinion on the matter. I know that reading a book isn't as fun as watching a YouTube video, but I promise you it's worth it. Just set 30 minutes to an hour aside every morning for reading. Waking up 30 minutes earlier isn't that big of a deal if you want to set yourself apart from the rest of the pack. Those 30 minutes to an hour every day will compound over time. 1 year in and your knowledge base will grow tremendously. Imagine 5 or 10 years down the line. If you want to read the book The Simple Path to Wealth to better understand all of the principles of building wealth by investing in low-cost index funds, make sure to get your copy. So I bought the Kindle version and the audiobook version and spent 1 hour every morning for 2 weeks or so to finish the book. It's a pretty small book. I purchased the audiobook and the Kindle version because I'm a slow reader and get distracted fast. Listening to the audiobook 2 times speed while reading along in the Kindle book helps me finish the book faster and better understand it all. If you don't have an Audible account yet, you can download the audiobook for free using the link below in the description. I believe the first book you download is free when you sign up for the first time. Before you go, make sure to leave a comment. Just a simple hello is good enough for me. See you next time. Bye bye, my friend.